Hi, Joel Baris from Israel, wrapping up the course and happy to present my capstone presentation. The problem I chose is next generation lending networks. The casebook correctly stated the importance of mortgages and mortgage backed securities in the financial markets. It is also important to take a moment and notice that the mortgage is the largest liability of a household, and the home that was financed through the mortgage is the largest asset of that household. Provenance is our client, and they use blockchain to create financial solutions and markets. I want to go back to the 2007 to 2009 crisis to understand what can we improve on. The crisis is often described as a vicious cycle that started with mortgage-backed securities creating more money in the market, pushing the price of homes up. When the bubble burst, the prices went down. The people had no reason to repay the loan that was at that point much more valuable than the home. The banks repossessed the homes and, having nothing to do with them, put them back on the market. The influx of supply pushing the prices further down. We have a cycle, we have a crisis. The difference between a recourse loan and non-recourse loan, this is obviously doesn't need much explanation, is when the farmer buys the cow in a recourse loan or regular loan, no matter what, he'll have to pay by giving the cow to the lender or from the other assets. Whereas in a non-recourse loan, the only recourse of the lender is to repossess the cow. What happens with a mortgage? A mortgage is by nature non-recourse, no matter what the legal definition, because, as we said, the largest liability and the largest asset of the homeowner is that home. So how can we hedge the risk of non-recourse mortgages? My suggestion is to sell future contracts on homes parallel to the mortgages. This can be facilitated by blockchain uh, smart contracts that will create an initial and a secondary market for the futures on homes. The smart contracts will allow for a predetermined set uh, circumstances to trigger the contract that will thereby transfer the ownership of the home directly to the owners of these future contracts. The advantages are that the pension funds can have nearly risk free investments in the mortgage backed securities. They can at the same time actually invest in futures on homes if they consider this a good investment. This will create a smoother transition in case of default and repossession, and possibly encourage rental after default, possibly even to the home occupants, and thereby creating a social advantage as well, and will reduce the need of the um, banks to deal with repossessing homes and then selling them. From the perspective of Provenance, our client, this is a unique use of blockchain technology, a unique business model, and will create unique opportunities. The questions, of course, are the regulations, and specifically the regulations regarding the pension funds and the taxation, but the opportunities are tremendous. We can actually redefine the mortgage market, create a futures market on homes, address the risk, and do all this utilizing blockchain technology and avoiding the risk that the very markets we're creating will distort the real markets. Thank you very much for the course and for listening to my presentation.